Assalamu alaikum. Today we are going to discuss a very important topic and also a very common topic for bankers, especially who works in a credit department or investing department. So, as a credit analyst, it is very important to understand financial statement. There are four elements of financial statement. Before proceed, uh, financial statements helps us to understand and to evaluate the financial capacity of the borrower. For examples, if I invest a certain amount of money to a certain business concern, so we need to ensure that we need to understand that the borrower has the capacity to pay back my money. So it is not something dealing with collateral or security or mortgage, something like that, or the man is good or bad. These are the part of screening mechanism evaluation process. But the important thing that the can the business generate enough revenue to pay my installment back in due time. So if it is not the case, if the evidence, if the financial statements does not give us positive picture, and that is alarming. So as a banker, as an analyst, we need to understand the financial statement very well, and through which we can predict the future capacity of the borrower to pay its obligations to the bank. Generally, there are four elements of financial statements. For example, there are four types of financial statement. That is balance sheet, number one. Number two, income statement. Number three, owner's equity statement. Number four, statement of cash flow. So each of the statements, I think, carries special significance from special perspectives. From balance sheet, we can see the quality of assets positions and liability positions. So in generally, there are common equation. We all know that is asset is equal to liabilities, or asset is equal to liabilities plus owner's equity. If we expand, there are assets, in asset part we can we can say that there are many important elements there, like cash receivable, account receivable, equipment, plants, and so on. From liability sides, we can conclude say that short-term liability, long-term liability, owner's equity, and also revenue minus expense. So there are so from balance sheet we can get the idea of the quality of the assets, that the how that the position of assets in terms of its equity, and the positions of its bank borrowing in terms of its assets, current assets. So, and from balance sheet we can get many picture of the business, and so we can, and through different horizontal and vertical analysis, and there are many analytical tools that can be applied for proper evaluations of the borrower. So another important statement is income statements. I think ultimately every business need to generate income, or need to ensure income. At the end of the day, income matters, because if you don't earn, you can't pay. So before investing to a certain borrower, we must ensure that the business has the capacity, and through historical analysis we must review the previous year's experience, that whether how much money the business can generate. If I invest $1 million, and does the business is capable of producing enough revenue after deducting all the expenses, that the borrower can pay the installments or the interest. So income statements now is also very important, some, because suppose in a particular period of times we can get the borrower can get a show some huge income. But in reality, if we check closely and properly, we can see that if the fixed asset or income is generating from selling fixed asset, or income is generating from excessive collection of receivable. So these are the very important things that we need to look at. And another important thing that is owner's equity statement. So sometimes in balance sheet we can't get the real pan picture, an accurate, precise picture, because we know that asset is equal to liability. If the liability, bank borrowing, is high, and owner's contribution to the business is low, so investing this kind of business is very risky, because the moment owners or the borrower limiting itself, its equity in the business, that means that the intention of the borrower is not good. So in case of any failure, or in case of any disaster, or in case of any unwanted or unforeseen situations, so the portion of the equity in the business is not enough to cover my liabilities. So my loan position. So owner's equity is very important to understand how much attachment the owner with the business. So more the owner equity is, the more the good for the investors. So another important statement is cash flow statement. I think cash flow statements gives us very important pictures through that whether the business can generate cash to pay its due, and whether actually we can through cash flow analysis we can get some very very important data or parameters, so that we can predict the future of the business. In future, the business can give my payment on regular basis. Without proper cash flow, a business cannot survive, because he has to pay suppliers money, accounts payables money, so suppliers money, creditors money, banks dues, and salaries and wages. So proper cash flow statement. So a healthy cash flow, or cash inflow and outflow, is very important for proper maintenance of the business. For examples, we have sometimes we notice garments unrest, factory are set at place, or production are disrupted due to that the wages of the laborers are not paid in due course before Idul Fitr or Idul Adha. So cash flow, maintaining proper cash for a business concern, or a manufacturing concern, or a service concern, for paying employees salary, for operating activities, and purchasing raw materials, cash flow is very important. And another important thing for cash flow statement is that that if the if some that whether the company has the capacity to purchase the raw materials that needed for productions, and maintaining administrative and selling expense, so advertising expense, marketing expense. So many expenses are required for smooth running of the business. So if you don't able to generate healthy cash flow, so business will not succeed, because its productivity will hamper, its labor unrest will occur, and employees will derail and demotivated, and suppliers and the creditors will be demotivated if we don't pay the cash, or pay the money on regular basis. So cash flow is important. Cash flow statement is very important. So another statement that is also important, so that is balance sheet. Oh, you have already discussed all those issues. Thank you.